in turn try to make it easier for every retail trader, even those who are not programmers, to benefit from this technology by launching PredictNow.ai. Here is the spoiler. The key to successfully applying AI/ML to finance is to focus on meta-labeling. That is, finding the probability of profit of your own simple, basic trading strategy and not to use it to predict the market directly. Why? Your own trading strategy's past track record is private. No one else is trying to predict its success. Meanwhile, millions of people around the world are watching the same public market, and everyone is trying to predict where it will go. Competition and arbitrage naturally mean that signal-to-noise ratio is very low, and predictive successes are few and far in between. But that's not all. There is another novel use of machine learning that I will discuss in a completely revised Example 7.1 on the accompanying PDF. Despite our luck with the longevity of some of the strategies I described, most arbitrage opportunities eventually fade away. The notorious alpha decay that professionals like to lament. Alpha decay can be due to competition, too many people trading the same strategy, but equally often it is due to regime shift, caused by market structure or macroeconomic changes. Adapt and evolve your strategies, or watch them die. Low 2019. The market is not stationary. Why should your strategies be? The most agonizing decision a quantitative trader needs to make is to decide when to abandon a strategy during a prolonged drawdown, despite repeated efforts to evolve it. It is ultimately a discretionary decision. You have to judge based on your market knowledge whether there is a fundamental reason your strategy stopped working. To gain this market knowledge, you have to constantly absorb public knowledge disseminated on social media. That is the reason I set aside an hour each day to go through my Twitter feed, at ChanEp. I have highlighted some of the Twitterers I follow in Chapter 2. More so than providing specific strategy examples, I hope my books will also improve your market intuition in making these discretionary decisions. One major addition to this edition is the inclusion of Python and R codes to every example. Even though MATLAB is still my favorite backtesting language, there is no reason to exclude the other two most popular languages. Other things that I added and changed in the second edition. Chapter 1. A bit more about fully automated trading and marketing your strategies to investors. Also a scare episode during COVID-19. Chapter 2 updated the educational and trading resources for budding quant traders, including the new URL for my own blog. Also a good word for Millennium Partners founder. Not that he needs it. Chapter 3 extensive changes on MATLAB code that remove a major bug, and new commentary and codes for Python and R. Description of some new quant trading platforms. One item of particular interest, I discuss a mathematically rigorous way to decide how much backtest data and how long a paper trading period is needed. Another mathematical technique was referenced that determines how data snooping will affect your live Sharpe ratio. Chapter 4. Much has changed in the world of brokers and infrastructure providers for algorithmic traders since the first edition. Even the name of the U.S. regulator for brokers has changed. You will find them all updated. Chapter 5. It is now much easier than before to build a fully automated trading system. The new ways are described in this chapter. Chapter 6. New insights on the Kelly formula and its practical impact. Python and R codes for demonstrating capital allocation using the Kelly formula are added. Also